Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. The stock market showed signs of upside exhaustion. However, the commodity markets are popping. Ross has a special offer for our listeners. Author of several books on the economy, including The Money Bubble, John Rubino, gives us his take on whether interest rates will continue to rise, will there be more banking failures in the U.S., and tells us Europe can no longer count on Germany to bail them out of financial difficulties. Hilliard Macbeth, author of the second edition of When the Bubble Burst, Surviving the Canadian Real Estate Crash, tells us about the state of Canadian real estate and are we about to see the housing market collapse? We'll talk to Ross Clark right after this.
Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclico.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at ChartsByRoss. Welcome back to This Week in Money.
Always good to be with you, Jim.
Ross, do you have a special offer for our listeners?
Yes. Things at this point, as we move into the summer, there's usually some pretty good opportunities, and we've had markets really lining themselves up very nicely, whether it be the equity markets, the precious metals, the grains, the oil market. Everything in here is pretty much on track for some pretty good opportunities this summer. So, we welcome people to come on board. 25% off for annual subscriptions for new subscribers, and that offer will be good through the end of the month. So we invite you to come along and try us out.
Russ, how did the stock markets end the week?
Ended the week down, depending upon the index, you're down anywhere from 1.5% to 3%. On Sunday, a week ago, we came up with upside exhaustion alerts in terms of the NASDAQ and the S&P 500, along with a lot of individual stocks that have been real high flyers. The AI stocks of the last couple of months. So at that point, these were the type of signals we hadn't. This is, I think, the fourth time on the NASDAQ that we've had this signal, and the previous time had been November of 2021. And that became part of a rolling top process in the S&P back at the same window there in time frame in 2021 November. That was the top from which we had a pretty hard correction. So this week, say the initial hit is fairly small still, bigger over on the Russell 2000, which had just failed to break out this year. It's just been stuck badly with a sort of a lid on it, and it was down over 3% on the week. Ideally, there's some support not too far underneath here as far as the broad markets are concerned. So we've got some parameters there that we put out in our publication this weekend.
What's going on with crude?
Crude, once again, stuck in this trading range, with still, I think, the downside bias in it. The rallies since we rolled over a year ago now, the recent rallies have been to the 50-week moving average, which was back in April, and then this month it's been capped at the 20-week average. This is the same what we've seen in the 5 bear markets when we go back for the last 3 decades here. So we are pretty much on track for the classic action there. There's still, I think, some more pressure to be seen as far as the oil market is concerned, but once again, parameters are in place here to hopefully identify an important bottom, and it looks as though we will probably see that before the summer's over. And the classic move coming out of these bottoms that we looking forward to would be anywhere from 45% up to 80% within the next 6 months. So catching a low this next couple of months could be a pretty good opportunity for investors.
What's happening with gold and silver?
Gold has broken its rising support line from the November lows as of this week, and that's right on track with the course that we've been looking for here. And ideally, looking for a basing period over the next maybe 6 to 8 weeks. This break of the support line was good to see. Interestingly enough, the commitment traders numbers did not show much of a change on the week, even though both silver and gold took a pretty good hit. But remember that those COT numbers are compiled on Tuesday, and the worst part of the break happened middle of the week into Thursday. So maybe as we look at it next week, the COT numbers will be a little more positive. Ideally, I'd like to see a bigger clean out right now as far as time and price is concerned on gold and silver. But this is another one of those ones that looks to be pretty good as we push our way through the seasonal weakness, which carries us into July, August, and look for some turnaround after that.
The U.S. and Canadian dollars, how are they faring?
U.S. dollar is been basing out here. Nice action. We got some oversold signals in there on the daily charts. It's the dollar index has got sort of this double bottom down at 101, and this week put in a low just around 102 and change. There's no definitive move in this other than to say it's a trading range, and maybe it's looking to get back and test the 104 level. And considering the degree of the decline that we had just recently, it's oversold enough to try and retest that resistance level.
On the anything else file, commodities remain hot.
They do, we had that commitment of traders numbers on the grains here back in May. It really jumped out at us, and we usually don't, look at the grain markets and too many of the commodities other than the basic industrial ones. But the COT numbers in terms of corn, they were at the lowest level in 3 years. Wheat was at the lowest level for the speculators in 5 years, and the commercials were on the other side of that market. And so the ETFs, the exchange traded funds, which are available to anybody who's got a stock account, those had rallies of 16 to 22% off that low. And anybody who took option trades, call option trades, would have had moves that were 300% or more in that time frame. And we put out sell recommendation in the middle of this week, right on the high close there on Wednesday. Take some profits on that one, and there will probably be further opportunities to buy those grains on a dip here in the next few weeks. The COT numbers at the end of this week show that there's still some room on the upside. So it'll be a matter of buy the dips and look for the next rally.
Ross, thank you so much for the update.
Always a pleasure, Jim.
My guest has been Ross Clark from chartsandmarkets.com. You can find him on Twitter at ChartsByRoss. Coming up, John Rubino next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is John Rubino, author of several books on the economy, including The Money Bubble. He founded the website DollarCollapse.com. You can find him on Substack at Rubino.Substack.com. Welcome back to This Week in Money, John.
Hey, Jim.
John, the Bank of Canada had paused raising the central bank rate earlier this month. They started raising rates again, this time by a quarter point. The Fed just paused on raising its rates. Is the Fed likely to follow Canada's lead after a pause and hike rates again?
Well, it looks like it. So it's not clear why the Fed paused, because they paused and then they announced they were going to keep raising rates at future meetings. So it didn't really accomplish much. But it looks like they intend to raise rates until inflation goes back down to their 2% target here in the U.S. The risk with that is that there's a huge lag between changes in monetary policy and the actual effect on the real world. So central banks tend to overdo whatever it is they're doing because they don't see the effect of what they're doing until it's too late to realize they've overdone it. So I think this could be a case like that, where interest rates will go up until something breaks, but the Fed is apparently going to do it. So look for another couple of bumps in the Fed funds rate in the next few months.
So in other words, the Fed will keep hiking until something breaks.
Yeah. That's historically how it works, and it looks like that's what they're headed for.
Yeah, like finding out how seaworthy your boat is by continually pushing the bow down until it's underwater. Oh, maybe that's not the best idea. Now, the Bank of England and the Central European banks hiked rates. Are there reasons or purposes any different than the Bank of Canada and the Fed?
Well, they both had inflation shocks lately, where the inflation rate that their central banks considered to be the most worthy of following have gone up much faster than expected. And inflation in both of those entities is actually accelerating. So that really spooked them, and they responded accordingly with pretty aggressive interest rate hikes. And I don't think it's over there either. But it's got basically the same thing going as in the U.S. and maybe Canada, where central banks will overdo it because they won't see the results of what they're doing until much later. The time lag is somewhere between 6 months and 18 months normally, with monetary policy translating into real world economic activity. So what these guys are doing now is, I would say, probably already too much tightening. But they're going to keep doing it because the inflation numbers, which operate with a big lag, are going to come in hot for a little while longer. So I really do think that we're headed for something very serious on the monetary front.
Yeah, I was going to ask, is another banking crisis on the horizon?
It is. And at least in the U.S. I mean, I can't speak to the rest of the world, but the U.S. banking crisis is kind of baked into the cake for a couple of reasons. One is that government policy has engineered two things: much higher long-term rates to go with the much higher short-term rates they're implementing, and an inverted yield curve where short rates are higher than long rates. The regional and local banks in the U.S. operate by borrowing short, in other words, taking in deposits from customers, and then lending that money longer to local businesses and local real estate and mortgages and things like that. So it works for them when short-term interest rates are lower than long-term interest rates. But now we've got that inverted yield curve where short-term rates are higher than long-term rates, and the bank business model doesn't work. So those banks are in trouble regardless of what else happens. But there's another thing. Those banks invest their extra money in bonds, like government bonds, the safest instrument that you can invest in. Well, when interest rates go up, the price of bonds go down, and these banks are required to report their paper losses on certain bonds. And so they're showing big capital losses in effect on their income statements, and that's spooking depositors and leading depositors to pull money out of these banks, which forces the banks to raise the money in order to pay the depositors who are pulling out, and they have to sell those bonds, which means that those paper losses become real reportable losses, which spooks depositors even further, and so on, until you get more bank failures. and maybe a run on all banks in that category, which is several $1 trillion if that happens. So the bank crisis that we have coming is going to lead probably to the government having to bail out these banks, which could lead to a currency crisis. So we got a big self-reinforcing process here, which is leading to a very dark place financially. Mm.
So with that out of the way, how can a person say your money is in a smaller bank? You don't want to see it go under, but you want your money in a safe place. The consumer, if you're trying to be nice, is stuck in a bad place as well.
Yeah. I mean, if you're a customer of a small bank, then you have this dilemma where, maybe you should take some of your money out of that bank just because the environment is bad for that bank's business model. But then by doing that, if a lot of people like you do that, it becomes a self-fulfilling prophecy. Yeah. And your bank just goes under, even though it's well run in its own self. And with the policies that it's enacted, they've done what they should do, but the world has changed in a way that's so unfavorable for these little banks that it's not clear how a lot of them survive. So it's a tough one. I mean, I have some accounts with a couple of regional banks, and I have pulled some money out lately, and I think a lot of other people have the same attitude, which is good for you as an individual, bad for your bank, and bad for the banking sector in general.
Yeah, Canada's different. We just have big banks and credit unions. Yeah. Now, again...
we're headed that way in the U.S.
Yeah. How bad could it get in commercial real estate?
Okay, commercial real estate is really part of the regional and local bank story because a lot of buildings have gone up in the last decade, financed with very cheap credit. And some of those loans are starting to roll over. But they have to roll over at much higher rates now, which makes, for instance, an office building that is seeing low occupancy because people are working from home and already kind of in trouble, it makes it even less valuable than it was before. And a lot of these big buildings are changing hands now, one way or another. Either they're being bought out at fire sale prices, or they're doing jingle mail where the current owners just send the keys back to the bank and say, okay, it's your problem now. And that's going to be a very big problem for the industry as a whole, the commercial real estate industry as a whole, and for those same local and regional banks that we were talking about, because they have a lot of this paper. So, it's a triple whammy for these small banks in the U.S., and I don't know what the solution is. And I don't even know if the government wants a solution. It could be this is all part of a plan to wipe out the small banks and shift us over to central bank digital currencies. We will see.
Yeah, the UK and EU inflation shocks, are those blips or signs of things to come?
Well, I think there's a good chance that there are signs of things to come in the sense that the financial markets in the UK and the EU are being destabilized by what's happening. So it could be that inflation keeps on going up and that causes interest rates to spike and that blows up the economy, or it could be that the response to past inflation is already severe enough to blow up the system in those two countries or those two economic entities. And I don't know. I think the only thing we can predict with any kind of certainty about both the EU and the UK is that volatility is going to be a big part of the intermediate term future, where you've got crises going in various directions and no real way to fix anything. So I would not be an aggressive investor in Eurozone bonds or UK bonds right now. It just feels like this, or stocks. It feels like this is a time when you just don't want those financial assets. Let this thing play out without having any exposure yourself is probably the smartest way to approach those two places.
Right. Europe's in recession. Is this the beginning of something serious for the euro?
Yeah, see, this is the tricky part. Inflation is rising in the Eurozone lately, but Germany and some of the other Eurozone countries have dropped into recession at the same time, which is the classic definition of stagflation, right? The difference this time is that Germany isn't what it once was. You used to be able to count on Germany to basically just take care of any stupid thing that happened in the Eurozone. Germany would step in via the European Central Bank and paper it over. Well, Germany has made some really horrendous mistakes in the past decade, and they're coming back to bite the country now. For instance, they messed up I won't go into excruciating details here, but they screwed up their energy system, and that in turn has screwed up their industrial economy, and it's leaving them without nearly the kind of financial resources that they once had. And they just came out and said, hey, we don't have any extra money left for the rest of the Eurozone. And they also screwed up by having Europe send a huge amount of money to Ukraine, which was all borrowed money. So that just made the EU's finances that much weaker by sending all that money to a proxy war. So anyhow, Germany is not as easily able to bail out the Eurozone if there's another Euro crisis. And it looks like there could well be one in the near term. So it'll be interesting to see how that plays out, because there's no clear solution when something bad happens there now.
Robert Kennedy Jr. is having a surprisingly big impact on the Democrats. Is this a fluke or a serious political event?
I think it might be a serious political event. He just did a 3-hour interview on Joe Rogan that had massive viewership and massive consequences beyond that. You know, there was a big controversy over whether some big vaccine guy in the U.S. who had been critical of Robert Kennedy and Joe Rogan should debate Robert Kennedy, and whether it makes sense for, quote unquote experts in a given field to debate the critics of those experts who may not be, credentialed experts in the field. Anyhow, fascinating, very interesting. And Robert Kennedy Jr., because of a lot of things like this, is rising in the polls. He's getting like 20% in polls versus Biden right now. And right now, the Democrats don't intend to have a primary or anything. They're just going to inaugurate Biden, send him out for re-election. But if he faces a serious challenge in the primaries, they might have to hold primary elections after all, and they might have to hold debates and things like that. And I think Robert Kennedy would just destroy Joe Biden in a debate. They're both senior citizens, but there's no comparison between the mental acuity of those two guys. So I think the Democrats right now are very spooked by what they might be forced to do in this election that they really don't want to do. And I think that's a big wild card out there, because you've got Trump being indicted for something here that actually some legal experts who are kind of sympathetic to Trump are still saying, this is a serious lawsuit with potential prison time here. So you got Trump on the one hand facing something that is unique to presidential politics, and then you got Biden on the other hand facing a serious challenge from a Kennedy. So this might be a much more interesting election than it looked like it was going to be.
Yeah, a trend in the U.S. In the next few years, 10% of all politicians will either be a Kennedy or related to the Kennedys. It's a magical name.
Well, I tell you what, you put Kennedy on a ballot in a Democrat primary or something like that, and you get an automatic 10%.
Yeah.
So I think I could name my dog Kennedy and run him in a Democrat Senate primary and get 10% exactly. Probably. And he would be a better senator than some of the current senators that we have. So, we're that kind of a country.
Gold and silver are treading water. Which way will they break when they start moving again?
Good question, because if we keep raising interest rates, we're risking a serious financial crisis in which stocks just get crushed and the economy slows down dramatically, and that's bad for gold and silver. The central bank response to that which is to say they'll open the monetary floodgates and we'll get extremely easy money again. That's great for gold and silver. So it could be that we have some real peaks in the future, but there's a valley in between here and those peaks. And I don't think that should stop you from gradually adding to your gold and silver stacks and to positions in the very best gold and silver miners and streaming companies and royalty companies. But I think it's something to be concerned about more psychologically than anything else, because it's hard to see your favorite stocks and your favorite assets just get smacked in a financial panic. But be prepared for that while you gradually add to the best, highest quality positions in this space. And I think a few years out, you'll be really glad you did that.
John, where can people follow you?
I'm at Rubino.Substack.com, and you can come and sign up for free to see what's there, and you'll get the vast majority of what I'm posting, and then a few things are behind a paywall. So if you like what you're seeing, you can subscribe and then see everything.
John, thank you so much for being on This Week in Money.
Thank you, Jim. See ya.
My guest has been John Rubino, author of several books on the economy, including The Money Bubble. He founded the website dollarcollapse.com. Find him on Substack at Rubino.Substack.com. Coming up, Hilliard Macbeth, next on This Week in Money.
Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclico.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Hilliard Macbeth, author of the second edition of the book, When the Bubble Burst, Surviving the Canadian Real Estate Crash. He's also a portfolio manager and financial advisor in Edmonton. Welcome back to This Week in Money.
It's always great to be on your show, Jim.
Hilliard, can you tell us a bit about the book and how it applies to what's happening with the Canadian real estate market right now?
Well, the book was talking about a crash in real estate, in housing particularly, and that didn't happen as soon as the book came out. In fact, it's been several years now, but it was early, and I don't think it's a wrong prediction. It's just something that is coming at some point soon. And the key element is the debt that's been taken on in order to support the housing market and other aspects of Canadian economy, is household spending, even business spending, and of course we've seen with COVID government spending as well. So when the time comes, and it's actually got a name now, it's called the Minsky moment, that the lenders discover that people can't pay back their debts, then that's when you see a big correction in house prices, and you'll probably see some bankruptcies among businesses, and the government will struggle as well. The government has the advantage so that they can print the money to handle their debts, but the rest of us, we have to either buckle down and pay off the debts, or we end up going bankrupt. So that's the situation, and it looks like we're just about there now.
Now, what would that scenario look at, and how do you protect yourself?
Well, the main thing is to be out of debt. So if we can possibly avoid going into debt or being deeper into debt or somehow get out of debt, the renewals that are coming up on mortgages now, which is the biggest chunk of, the debt in households in Canada is around 100 to 110% of GDP, which is about $2 trillion. So about 70, 75% of that, $1.5 trillion, is in mortgages. And the mortgages now are coming up for renewal. Some of them, the variables have already jumped from 1.5% up to 6%. And some of the 5-year mortgages are coming up for renewal that were in the 2 or 3% range, and now are going to be 6 or even higher than 6% now with the latest increases in central bank rates. So that's where people are going to see their payments going from, say, $1,500 a month to $3,000 or even $4,000 a month. And that's the thing to do, is to try and get out of that. Because the thing that the lenders are offering now is to extend your amortization to 30 or 40 years. And the problem with that is you end up paying, a house that costs $500,000, you can end up paying $1.5 million for that house if rates were 7% and you extended the amortization. You'd pay triple the cost of that house because of all the interest you'd pay on that mortgage. So the number one thing to do is figure out a way to get out of debt. Even if it means a drastic change in your lifestyle, it's very important.
This month, the Bank of Canada began raising the bank rate again. Could we see rates trending higher for a while?
Yeah, they released the minutes of the meeting, the Bank of Canada meeting that occurred in just before the June change, and they talked about having to raise rates again in the future. There's no guarantee; it depends on data and that sort of thing. But one of the things that disturbed them was the trend in housing. So they mentioned it a couple of times. The housing activity was picking up, and also house prices were rising again too. Now, resale house prices aren't directly measured in CPI, as we've talked about several times, but it is an indicator of the direction that inflation is going. So shelter is the biggest component of CPI, and at 32% of the headline CPI and 40% of the core CPI. And if shelter, big part of shelter costs is mortgage interest rates. Mortgage interest rates are going up, so therefore shelter is going up, and therefore CPI is going up. So the bank, by raising interest rates, is actually forcing CPI higher, and they expect to raise interest rates in order to get CPI go lower. So they're pushing and pulling at the same time, and it's going to be a long process, I think, unfortunately. In England, the Bank of England just raised rates 0.5 percentage point, the other central banks having stuck with 0.25 point. And the reason they did that is because of CPI inflation jumped up to, I forget the exact number, 8.7% or something like that. So there's some shocking things happening in the inflation category. Everybody a few months ago thought that inflation was going to come back down to the target of 2% on its own. I never believed that. I've talked on this show about that and written about it as well. And I think it's going to be a much tougher battle than that. We're going to have to fight really hard to get inflation back down. And there's a lot of debate as to whether it's the right thing to do. A lot of people say it's not worth having a severe recession in order to get inflation down. So people are not 100% on board with that idea. But the central banks seem to be convinced that that's what they need to do, and they probably will go ahead with that.
Hmm. Well, if everybody's employed and your pension is geared to take inflation into account, yeah, you can live with it. Plus, having a banking account that actually pays you money, that's an interesting phenomenon we haven't seen for years.
Yeah, I just talked to a guy yesterday, and he said that he's getting, as long as even a small amount of money in his bank account, he's getting 4.75% interest. So it's been 20 years since we've seen that, right? So people, and this also feeds into a slowdown in the economy, because people were, I remember not that long ago, a couple of years ago, people saying, well, it's, money's basically free, so why wouldn't I borrow more money? I can't afford to turn the bank down. If the bank's offering me more money, I have to take it. Well, now it's exactly the opposite. If I pay down my debts, I'm saving 6-7%, and I can actually get some money on my money I deposit with the bank. So the thing swings very rapidly from speculative bubbly fever to basically a very cautious approach where people cut back on their spending and pay down their debts. The problem with that is it really hurts the economy, because in the last decade or two, consumer spending has become 70% of the economy. So if consumers in aggregate decide to pay down their debts and cut back on their spending, it has a big negative impact on the economy. That's Keynes in the 1930s wrote about it. He called it the paradox of thrift, and basically says that individually we can pay down our debts and get our life back on track, but collectively we cannot, because of course everybody's spending is somebody else's income. So if everybody stops spending, then a whole bunch of people lose income, and that's the problem with this thing. So the one entity that can step into the gap there, if all businesses and consumers are cutting back on their spending at the same time, which seems what we're headed into here, if that happens, the government can step in and increase their spending. But unfortunately, the government spent so much money on COVID that there's going to be a lot of people that are very worried if the government decides to step in and start spending again if we go into a recession led by consumer and business spending collapsing, which so that'll be a debate for 3 months from now, 6 months from now, or something like that. But it's certainly not going to help the house prices stay higher. I think they'll have to come down.
Are banks and credit unions making it tougher to get loans?
Well, yes. Bankers are human. Believe it or not, they do seem to be human. And they've had a tremendous amount of pressure on them from their head offices to expand the number of loans they make and the number of credit cards they issued and the number of HELOCs they sign people up for. But when they see people starting to fail to repay their loans, of course, then they get afraid to make a loan, and they start to check the applications much more carefully. CIBC just announced yesterday or the day before that they discovered that a whole bunch of people had been approved for loans that shouldn't have been approved for loans, or they were approved for loans with too much loan limit that was too high on the HELOCs or on the personal loans. So they said it was a computer error, but I'm a little skeptical about that. We saw in Wells Fargo in the U.S. that in order to make their targets, the employees were just doing whatever they could to expand the number of loans and the size of the loans that they made. And I suspect it's the same in Canadian banking. There's a lot of pressure on the employees to meet their targets or exceed their targets to get bonuses. And so who knows? In any case, what happens is the banks, the big lenders being the big banks, they uncover that they've been lending too much money to people who maybe can't afford to repay the loans, and they start to scale back. And once they start doing it, they can use that excuse to do more of it, because now the pressure isn't on anymore to meet their targets. The new pressure is to avoid lending money to anybody that's going to go bankrupt, so that they don't hurt the bank with bad loans.
Is inventory returning to the housing market?
Yes, it's coming back rapidly, and so there's two aspects of this. I know people have talked about housing and say, well, people have their idea of what they want to get for their house, and they don't have to sell, and they can just sit on it. And half the houses, according to the banks, I'm a little skeptical about this statistic I'm about to give you, but they say half of the people in Canada don't even have a mortgage, which seems unlikely to me. But if that's true, then they don't have any pressure on them to sell their house. They could just decide, well, if it's a weak market and I have to discount my house price, I'll just hang on. I won't move. I won't go to that apartment or that condo. I'll just stay in my home. But there's two categories of people that sometimes must sell, and first of all is the new home builders that need to get rid of that inventory, and the second one is speculators who have bought condos, especially, or single-family homes with the idea of flipping them. And both of those people are forced to sell because of the fact that they are almost always operating on borrowed money. So that's what happens. Those prices start to come down because those people are forced to sell, and that drags the prices all across. I mean, if a brand new house of the same equivalent size is selling for $200,000 less than the resale house, then people are going to go for the brand new house every time. So that'll drag prices down all across the board, even though the inventory maybe isn't as plentiful. But even in some of the older established neighborhoods, you can see that the number of for sale signs is starting to go up rapidly. And that may be people that have put off the idea of selling, watching prices go higher and thinking, well, I'll wait. And then now they're seeing that prices are starting to soften and they don't want to miss the opportunity. Because for a lot of them, they're looking at listing their home at, say, $1 million, and they've only paid $300,000 for it. So they might be able to say, well, even if I have to drop it to $900,000 to get rid of it, I'm still tripling my money, and I want to make the move because there's other reasons, lifestyle reasons why people want to make a move. So the inventory could increase quite dramatically, but it'll be driven mostly by people that are forced to by the lenders, whether the lender takes over the property or just puts pressure on the speculator or the developer to make the sales and get the loans paid down.
Are the extended amortization mortgages for people struggling to pay their mortgages turning out to be a good thing?
It's a terrible thing. I mean, I understand why they're doing it. It makes sense in the short term, but unless there's some new thing that's about to happen, 3 months, 6 months, 9 months down the road, like a maybe an increase in income in the household or something like that, all you're doing is digging the hole deeper, because now they're going to owe more money by extending the amortization. And they're talking about some numbers like 25 or even 30% of the people with the extended amortization only paying interest only on their loans. So that means their loan is not being paid down. And what that, at 6.5% on a 25-year mortgage, people pay double the house. So if they buy a $1 million house, they're paying $2 million when you count up all the interest over 25 years. Well, if they extend the amortization to 30 and 40 years, it'll be triple. It won't be double. It'll be triple. And if interest rates go to 7% rather than 6.5%, it'll be even worse than that. So they're not doing the borrowers any favors by allowing them to extend the mortgage. It'd be much better to force people to come to some kind of an agreement with the bank on what they can afford to repay, or if they have to sell the property, then get on with it. Get on with this process of liquidating houses away from people that can't afford to own them.
It's also amazing the number of people who don't know that you can pay down your mortgage every week or pay twice a month, and that'll take a 25-year and knock it down to 15 years. And if you do it every week, same amount per month, but just give the bank the money every week, and that can shorten your mortgage down to 12 years. So it does make a huge difference in the total amount of money you pay. So maybe negotiate that. Pay more often, so you don't have to.
I mean, those people aren't going to be the people that lose their homes because they have a little bit of extra money. They're organized and they're able to do that. But the people that were living on the edge and they just got carried away and they were right on the edge with $1,500 mortgage payments, and now at $3,000 or $4,000 mortgage payments, they just can't make it. Because other thing that's going up is taxes and all the different other things in life, the cost of food and energy and everything. With inflation, everything's gone up. So holidays are getting ridiculously expensive. Now those are discretionary, but people, I don't know very many people that are willing to just cut out holidays for a couple of years to pay down their mortgage. But we'll see if they're willing to do it, because holidays are getting very expensive, and so we'll see how it goes. It was certainly. This is new. This has not happened for 20, 25 years. This is why the housing bubble got so far out of control, is because people had never faced these kind of realities since the 1990s. There was two incidents in the last 50 years or so, in the early 80s and then again in the mid 90s, when people got into trouble with their mortgages and struggled with their debts and stuff. And after each one of those, people said, "Well, I'm not going to get into that mess. I'm not going to get into that kind of trouble again." But then the memories are short, right? or it's new people. Maybe the people that went through that never did get back into debt, but new people are always coming along. And I don't know. I think one of the most debilitating things that happened was when banks changed from being conservative organizations to becoming promotional and salespeople. When they started selling debt as if it were a sexy thing to have. And the slogan that comes to mind is the one that the Bank of Nova Scotia put up, called "You're richer than you think." And the program there was that you could tap into this household equity that you'd built up and use it to get a loan, and then you could go on that holiday or buy that new car or whatever. Well, people worked hard to get the mortgage paid down, and now they're being encouraged to make the mortgage go back up again. And it works for the lender because they get more interest, they get a bigger loan, they can have more income from that household. But it's not good for the household in really any way. So it was unfortunate, and it went on for a long time, and a lot of people got into debt over beyond what they can really handle. And now we're going to see what happens. It'll be a real eye opener for a lot of people. I think a lot of people will be shocked because they viewed the lender as this conservative entity that was giving them good advice as to how much debt they can handle. So they'll be a little bit shocked when they find out that the amount of debt that they have is way beyond what they really should have had.
How much income do people need to afford a median-priced home in Vancouver or Toronto?
Well, so these numbers are ridiculous, right? So, it's the average person, like the average household. Let's say the Canadian thing now is there's two people usually working in the household. The averages are under $100,000 a year. In Toronto, Vancouver, and Edmonton, Calgary, they're around $100,000. They're the highest in Canada. And in Toronto, Vancouver, they're lower, like 75, 80,000. And the old rule of thumb on housing, these numbers are ridiculous, was 3 to 4 times household income was the maximum people should be paying for a house. So we're talking in this case, so let's just round it up to 100,000 to make it easy. We're talking 300,000 to 400,000 for a home. And for decades, that was the top end of the range that people would use to buy a home. Right up until about 1998 or 1999, that was kind of where it was. And occasionally, a couple of times, it got a little bit ahead of that, and then there was a housing crisis, and it came back down again, and a few people lost their homes, and then something happened in 2000, and the people started to get encouraged to buy bigger homes and more expensive homes. Prices went up. The lenders were willing to finance them. By 2015, I thought, when the first edition of my book came out, that it was already at 6 or 7 times income, almost double the previous limit of 4 times. And now in Vancouver and Toronto, we're looking at 10 to 12 times income, which is just off the charts. And there are a few places in the world that are similar, but generally they tend to be places like San Francisco or Singapore or Hong Kong or something where there's a lot of financial people that are there as
in Hong Kong, they take out 100-year mortgages. They expect your predecessors or your kids and their kids to continue paying it. But eventually, I guess after so you've gone through 4 generations.
Yeah, I mean in Japan, it was quite common. Japan had a huge bubble in 1989, and it wasn't so much housing because people in Japan didn't trade houses like we do. The house would stay in the family for generations, and so it wasn't. The land prices went way up, but the housing prices were you couldn't really get a good read on it because there were such a limited amount of activity. But it was quite common for a house to stay in a family for 3 or 4 generations, and so you couldn't really tell what house prices were because they seldom traded hands. But yeah, no, Vancouver and Toronto are very special in that regard, and they have Vancouver with a lot of foreign investors, and Toronto with a very highly paid workforce working in the financial sector downtown. All the banks have their headquarters there, and the senior banking people are very well paid. So we'll see if it. I mean, 10, 12 times seems way. It's basically triple what people can really afford. But we'll find out if it's sustainable or not. One of the things that has changed since in the last 8 years, which is new, is the work from home phenomenon. Because if you don't have to live in proximity to downtown Toronto or downtown Vancouver, you don't need to pay $1 million for a starter home. So when the combination of those things gets sorted out, you may find out that the house prices in those big cities are not sustainable at those high levels. The main thing that caused them to be like that was proximity to high-paying jobs, and a lot of people now are not required to be close to. I mean, you probably still have to go to the head office once or twice a week for meetings and stuff, but that's not so bad. I mean, even if you have a 2-hour commute, if you only have to do it once a week or twice a week, that's kind of like a fun thing, outing to do. If you have to do it every day, it's a grind. But if you have to.
Ian Pretty was on the show a few weeks ago. His price drop prediction for the median price of homes in the Canadian bubble cities of Vancouver and Toronto was 65% and an overall drop of 75%. What are your thoughts on that? Our price is going to fall that much.
Well, those are pretty high numbers. Like the drop in the U.S. The U.S. is the most recent similar place that we have a number for. The average price in the U.S. went down 38% over 4 years, from 2006 to 2010, bottomed out in 2010. And those prices have come back now to basically, they're even maybe a little bit above where they were in 2006. So that was a pretty, rounded off to 40%. The Canadian bubble now, though, so I compared in my research for my book, I compared the level of housing in 2006 in the U.S. to what Canada's dealing with today. And or at least a couple of years ago, and Canadian bubble is much, much more expensive than the U.S. bubble. So the U.S. bubble peaked out at about 4.5 times household income, And, of course, house prices have always been a little bit lower in the U.S., at least recently. And Canadian house prices are peaking out at more like 7-8 times. So we do have further to fall. So it's going to be at least 40%. I don't know if it'll be as high as Ian Priddy is saying. You could throw those numbers out. It depends. I mean, if the government just let the housing market correct and didn't intervene, it's quite possible those numbers could be reached because and of course the thing is, it's not like every house is going to trade at that price. We're talking about a benchmark price, which is achieved by probably a low price like that would be achieved by foreclosures and forced sales. And so it would be 5% turnover in housing is a big turnover. So 5% of the houses trade at that lower price, and people say, well, that means the other 95% are also worth that much. Well, that's probably not true. You know what I mean? It's like you get these unusual things that happen in when there's a lot of people getting foreclosed on and that sort of thing. But will the government allow that to happen? Will the government allow what they call price discovery to actually run its full course? I don't know. I mean, there hasn't been any sign of the government allowing that. Lately, what we've seen with governments, and it's not just the Canadian government, but everywhere, is as soon as any kind of difficulty shows up, they jump in and try and make it go away. A recession happens, and they put interest rates down to zero. COVID comes along, they give everybody a whole bunch of money so they don't have to suffer any consequences from COVID. So what are they going to do when people start losing their houses? They'll probably jump in and do something then. So my guess is we won't see those kind of price drops because there'll be intervention. But we definitely are going to see some price drops, maybe just not quite that large.
We're hearing 30 to 40% of housing stock in BC and Ontario is owned by investors. At the end of the day, could investors end up taking the housing market down?
For sure. So I saw the article. I think that came from, there's an article about condos, and they say that investors, they call them investors. They really should call them speculators, right? They're not really investors, and I'll explain in a minute why they're not investors. They come in on a new building. They'll say, "I'll take the whole floor. I'll take all 10 units on that floor." And I heard that years ago, even before 2015, when my first edition of my book came out. I heard that from people in Toronto saying, "Yeah, there's people coming in." Now they might be laundering money, in which case they don't care if the prices go down a little bit or if they lose money on that. Once they buy those pre-construction condos, they have achieved a good part of what's involved in cleaning dirty money. But if they're just people that are trying to make money, they have no way of making money because condos are a terrible investment. And that's why I call them speculators rather than investors, because invariably when you go to rent out that condo to a tenant, you end up losing money on a monthly basis. Now, up until recently, it was only a few $100, $100, $200, $300, depending on how rigorous you were on the accounting for what it's costing you to own that condo. Mortgage, taxes, condominium fees, all those things, maintenance. And if the investor put any kind of value on his or her time in terms of managing that property, finding a tenant, the time when the tenant leaves, and then you got to get another tenant, and there's a couple of months when it sits empty, and then you got to refurbish it because some guy punched a hole in the wall or something. Well, if you added all that in, there's no way a condo would actually be a positive cash flow thing. So I talked to several of those people and asked them, why are you keeping this condo? And realistically, you're probably losing $100, $200, $300 a month. And they said, well, we're expecting to sell it for a profit at the end. When we get that profit at the end, that'll make up for those losses, right? So I thought, well, that's crazy because a 10-year-old condo is not, there's always new condos being built. Who wants a 10-year-old condo? Like, it's compared to a new condo, it's not as good. Anyway, those people are speculating basically because if it was a positive cash flow that say equated to what you can get in a bank account at 4.5%, 5% of GIC or something, then that would be an investment. But if you have to feed that investment every month because you're losing money every month, then basically all you're doing is you're speculating on the sale price when you actually flip that to try and make a profit on the asset price. And that's speculation. So that's the difference between investing and speculation. But they call them investors. And I saw those numbers, I was shocked. I don't know if that's accurate. That was sort of Statistics Canada housing investigation that they're doing. So I'm guessing probably that they probably are pretty accurate. So that's we talked a minute ago in this interview about whether inventories are going to increase and people will be forced to sell. And there's a category where there'll be a lot of forced sales coming out through. These speculators will be unless they don't have any borrowed money. But if they have borrowed money, they're going to have to start to unload some of those properties fairly quickly.
For the bubble cities, what percentage drops could we see in the low end, mid range, and high end properties?
Well, if you take that that number that we saw, household income, and you round it as we said, 100,000 per household, which is actually a little too high, but makes the math easy. And let's be generous and say the old rule of 4 times household income is 2. That was then. This is now. We got a new number. Let's say 5 times is what people can afford at these current interest rates. Then we're looking at 500,000. And the average home, if you include condos and all that, I don't know the exact number, but I think in Toronto it's around 700,000-800,000. So let's say 800,000 in Toronto to they'd probably be $1 million in Vancouver. So in Vancouver, that would imply a 50% drop in house prices, and in Toronto, it would imply about a 40% drop in house prices. And that, to me, that would be realistic. So if if an average home, this is not a great home, this is not something that people would get excited about buying, but if it comes down to 500,000 and people have an income of 100,000, then they can probably manage that. So as long as interest rates don't go too high. I mean, in the 80s, when interest rates went to 15% for a mortgage, then those people, the most they could afford with 100,000 income would probably be 300,000 or less. But in today's market, with interest rates at 6.5%, they probably could handle 500,000. That would be a realistic number for housing. I would say that would be where you'd start to say housing affordability had been restored. Will it get there? I hope so, because whatever we're doing now is not working. It's just not sustainable at all. And and obviously that effort everybody made to help people afford those homes by putting interest rates down to 1.5% was a huge mistake. And I think central bankers and the governments realize that now, that they made a huge mistake, because all it did was get people in over their heads, and now we've got a huge bout of inflation coming as a result. So the tricky part, though, is how do you get from here to from here to there? Well, the first step was to raise interest rates, so they've done that, and a second step is watch and see what happens. But we're at the stage of the thing where some people are going to get hurt badly, and other people are not going to get hurt much at all. So it's a question of who pays and who gets hurt. And unfortunately, that's not always done fairly. Sometimes it can be done in a way that it just exacerbates income and wealth inequality, which is really unfortunate, because we don't need any more inequality than we already have. The inequality is already off the charts, and it's not good for society. And so, but it's going to be difficult to reduce inequality in a period when housing is in a correction.
When you look at past extreme real estate cycles, when do the significant price drops kick into gear?
Well, we've never really had a significant cycle. We had one in the early 1990s, and it took place over a couple of years, and then we had an even bigger one in the early 80s. And in the one in the 80s was interesting, because it was similar to today, in that inflation went above 10%. Now, inflation didn't actually quite get to 10% this time, but the authorities thought that they needed to keep raising rates, and they kept raising rates up to depending on which rate you use. But the long-term government bond rate got to about 15%, and mortgage rates got to also be about 15%. Although there weren't very many people that took out mortgages at that rate. And Canada Savings bonds got to 19%. And that was all in a period when inflation was 10 to 12% for a couple of years. And there were 2 recessions. There was one in 1980 and one in 1982. And they kept raising rates. This is what people don't realize. They kept raising rates through the recession, even though and these were severe recessions. We haven't seen recessions like this for quite a while in Canada, like the ones we had back then. So that whole thing played out over a period of, say, 5 years. The current market we're in now is probably been going for a year and a half now in terms of if you look at the stock market, which is one way to look at it. Mm-hmm. Housing is a little bit harder to evaluate, but if we look at the stock market, we're basically 18 months into this thing, and if we think that the average correction like that in the housing market or the bear market lasts 3 or 4 years, if it's a severe one, then we're pretty close to halfway through. That's the good news. The bad news is that the second half of any kind of a correction like that is usually worse than the first half. So we haven't seen the worst, but especially in housing, we haven't seen the worst part of it yet.
In the early 80s, mortgage rates roughly doubled. Since early 2021, mortgage rates have roughly tripled. So generally, how long does it take for these increased rates to affect home prices?
Yeah, they were doubling from a high, like for up until the 2000s, the start of the 2000s, the average mortgage rate, and it was distorted by those high rates we had in 1980. But the average mortgage rate was 9%. So it wasn't that big a stretch for the mortgage rate to go from 9% to say 15%. But with rates so low at 1.5%, if they have to go back to 9%, that's going to be ridiculous. That's a six-fold increase. But it isn't so much that 9% is so ridiculous. It's that 1.5% was completely unrealistic. So you can't really go by that benchmark. But if you go by the inflation rate and by the long-term experience prior to this craziness that we've had for the last 15 years, then mortgage rates in the 6, 7, 8, 9% range would be normal, and that's probably what's going to have to happen if they're serious about getting inflation back down to the 2% target, and if they want to get housing back to an affordable rate again, then they're going to have to do that. I never have understood why does a young couple with a decent down payment have to pay the same mortgage rate that a speculator pays, right? So why not have a premium interest rate for a speculator and maybe even a more generous rate for a young couple who's because a young couple, for one thing, is a safer bet in the sense that they're more likely to keep paying the mortgage payments. If a speculator gets into trouble on the housing, they could easily just try and walk away, and they'll probably end up having to declare bankruptcy, but they can't get out of the obligation.
Yeah, their company declares bankruptcy. They don't.
Yeah, and it's really easy for them to do that, and some of them have done it multiple times. So there should be a premium interest rate for those people, much higher than the regular interest rate. And there may be. I mean, a lot of times the banks won't deal with them, and then they go to the shadow banking where the rates are higher. But even shadow banking and lending rates, when the bank lending rate for reasonable mortgages got down to 1.5%, the shadow banking alt lenders, they call them, or they got different names for them. They were higher, but they were like 4 or 5%. That was still ridiculously low. I mean, those premium rates probably should be 10 or 15%. So, and I don't know the exact numbers. So I'm just using representative numbers. But yeah, if the regular 5-year mortgage rate for a family is 7%, let's say, then there should be a premium rate for a speculator that's more like 10 or 12 or 15%. In which case, at those rates, especially if house prices are not rising or even going down a little bit, gasp, then you're not going to get much speculation. The speculators they'll disappear. They don't necessarily completely die out, but they go and move on to something else like Bitcoin or. One of the things that might happen next is gold. Gold prices are pretty reasonable compared to a lot of these other speculations out there. And if something, the stock market's pretty expensive right now, so it's not likely to be the stock market, but something else will come along other than Canadian housing that the speculators will latch on to.
What happens in human psychology that turns a real estate downturn into a crash?
Well, we always say that greed and fear are the two big things. And it really is. It's greed on the upside, and the bankers and everybody are feeding the greed. And then when the downturn comes and people start hesitating, all they have to do is hesitate a little bit. If all of them hesitate at the same time, there's a whole bunch of houses always for sale, and they don't sell. And everybody looks at it, and then there's more houses for sale, and the prices come down a little bit, and then people get even more hesitant to buy. Then panic starts to set in, and so that's what. I mean, you don't get 40, 50, 60% drop in house prices without a whiff of panic in the air, and that's people that have paid off their mortgage, they look at all this, and they kind of look at it as an observer and say, well, that's crazy. I'm not getting involved in that, right? But I don't know what the percentages of homeowners are in Canada that would be caught in the panic, but it's got to be some. I've seen actually the Bank of Canada puts out a report, and they used to put out this report where they showed where the high ratio mortgages were. And Vancouver had a whole, they had different colors for who had the highest mortgage, and parts of Vancouver had really dark red or whatever the scariest color was. So and to some extent in Toronto as well. So those will be the areas. And is it 10% of Canadian households? It might be 20% of Canadian households. Who knows? But if there's 10 million households in Canada, 1 or 2 million households will be caught in the grips of fear and panic, and that's enough to cause the average price to come down, because those will be the transactions that happen, right? So the real estate board does all kinds of manipulation of the data to try and eliminate the outliers as being not representative, but at some point they'll probably have to admit. Now, one of the things that happens is not all foreclosures are done on MLS. If it's not done on MLS, it doesn't show up in the averages. So that'll be interesting to see if we actually do see the so house prices could come down by 50%, but you might not see it show up in the CREA average. But that doesn't mean the prices didn't come down. It just means that the average didn't capture all of the outlying, the extreme events.
Could Canada already be in or heading into a recession, and how long and severe could it be?
Well, people have been talking about a recession for quite a while, and one of the things that happens is like a housing bubble bursting forecast. The longer that it doesn't happen, the more people become, well, that didn't happen, so it's not going to happen. But in the case of a recession, there's always another recession coming. It's just a question of when, right? So they generally tend to happen every 4 or 5 years. It's been quite a while since we had one in Canada. I'm not counting the COVID recession because it only lasted like a month, right? So that's not. Let's ignore that one. So if you ignore that one in 2020, you have to go back till 2009. And the problem with that is that the one in 2009, which was very severe for the U.S., was actually quite mild for Canada. So Canada never really had to deal with some of these things like debt issues and stuff like that in that recession. It didn't last long enough for people to really start to get into trouble and lose their homes or that kind of stuff. So this next one that's coming, which is I think could possibly have already started. The data are always late on recessions. There's revisions that happen after the fact. There's in the U.S. The U.S. has much better data than Canada has, and in the U.S. I just noticed that the leading indicators, which is a pretty reliable indicator of recession, has now declined for 14 months in a row. So I think it goes back to April of 2022 was the last time that expectations and leading indicators actually went up. They've been going down for 14 months straight, which is I don't know if that's ever happened before. The other indicator of recession is the inversion of interest rates. So what happens is interest rates on a 10-year bond are, let's say, just to pick a number, 3.5%, but interest rates on a 1-year bond are 5% or 4.5%. So that's where the yield curve is inverted. So you get paid more for having, and the reason for that is that's an indication that the people that buy those 10-year bonds are expecting that there'll be a recession. That's the theory behind it anyway. People don't fully know why the yield curve inverts before a recession, but the one thing they do know is that it always happens, or when it happens, there's always a recession. Now, the yield curve has been inverted for quite a long time now. So there's another example of one of those things where at the beginning, when it first inverted, everybody said, oh, my God, there's a recession coming. But after several months of the yield curve staying inverted and no recession, people say, oh, well, maybe it's not a recession, but it probably is. And so you got some pretty strong indicators of recession. The other thing that from the stock market world, which is my main activity, earnings are declining, which is also very rare. So the S&P 500 earnings have been in they call it an earnings recession. And, it's only 5 or 10% right now. So, but that's also an indicator that there may be a recession coming. But you could also just look at it and say, you know what, when people try to cope with 6-7% interest rates, when they borrowed the money at 1.5 or 2%, at least some of them did, they're going to have to cut back on their spending. And when you add an inflationary situation on top of that, unless they get their wages and salaries increased by the same amount as inflation or more, they're going to have to cut back on their spending, and that's what creates a recession. Because just to repeat what I said a minute ago, everybody's spending is somebody else's income. So when everybody cuts back on spending, somebody else is losing income, and that's where you get into recession.
Could the replacement of jobs by artificial intelligence lead to a severe and prolonged recession?
Well, that's an interesting question, and I don't know the answer to that. I just finished reading a book about artificial intelligence, and I have to say, it's not something that I would expect after having read that book. It's going to hit us all at once. I remember several kind of hyped things like AI that is being hyped now that came and went, and they didn't affect us right away. And the big one would have been in 1999, 2000 with the .com era. Now, there's no doubt that all of the predictions that said the internet, this is, when the internet and the .com bubble, the stocks were trading at 100 times revenues and stuff, which is what we kind of have now with the AI stocks. Actually, a lot of those predictions were accurate. The internet changed our lives, but it didn't happen nearly as quickly as people thought. So people that bought stocks in 2000 based on that lost a lot of money. Like Amazon's a good example. Amazon was trading at $65, and it went down to $6. It went down 90%. And yet it turned out that it was a big beneficiary of the advent of the internet, because what Amazon does could not be done without the internet. And it just took many, many years. And so I think this AI thing is but yeah, there will be some jobs that will be eliminated, and it's just really hard to predict. Robotics, not necessarily AI, but robotics already is having a huge impact on the automobile industry. The manufacturing that Tesla is doing for electric cars is way different from the manufacturing that Ford and Chrysler and GM have been used to doing. And this is why the legacy automakers are having so much trouble making the transition, because they're still trying to make electric cars the way they've always made cars. And Tesla's moved on to a different way. And Tesla's profit margins are way higher. And the amount of intellectual property that they put into a car is just way beyond anything that comes in a regular car, and they don't employ nearly as many people, which is one of the reasons why they're having a little trouble gaining acceptance at the government levels, because governments like to see businesses that hire lots of people, and so Tesla is struggling a little bit because they're using a lot of robotics, a lot of machinery, and not very many people. But that's the future, and that isn't even AI. I guess it's a version of AI. I mean, if you think about electric cars, you could say that's one of the products that would be affected a lot by AI. But AI takes a long time. It's not as sexy as people think. It's a lot of times it's just loading a whole bunch of data into a huge number of computers and crunching the numbers for a long time, and then coming out with patterns and using that to make predictions, and that's been going on for a while now. But it may not. And then this concern about the AI machines taking over from humans, and like in the Terminator, deciding to kill all the humans, because they're and that also was in the movie Space Odyssey 2001. But the reality is that the AI requires a vast amount of computers and computing power and electricity. All the humans have to do is just unplug all that equipment from the electricity source, and that's the end of the AI. So I don't see the humans getting eliminated. But your question was about jobs, and I think there will be an impact. It's just we're not going to see as quickly as we thought.
Could a severe recession cause immigration levels to drop significantly due to high unemployment?
Well, a strange thing happened yesterday. A report came out that the Citizens and Immigration something in the Canadian government has revised their numbers, and they've lost. These are people with temporary work permits, right?
Yeah.
They dropped 300,000 people off the numbers. So from sometime a few months ago till today, February, I think it was February till today, 300,000 people have removed, and they didn't explain what happened. They said the data was faulty. So all of this hype about all these people that were coming in terms of these are people that come in on a 1 or 2 year visa.
Yeah.
But that's the main source of people that become permanent residents eventually. They were talking that we were getting 500,000 a year or something. Well, they just removed 300,000 people from the number, so we'll see what happens. But certainly, people generally come for work, whether it be interprovincial, like people moving from Ontario to Alberta, or people moving from countries like the Philippines to Canada. They don't come here because they just decide one day that they're going to leave their family behind and they like the weather in Canada better than the weather where they come from. They come for work, and a lot of times they don't actually plan to stay. They might go back once they've worked for a while, but in the end, a lot of times they stay. So, but if the jobs aren't there, they won't come. There's no question about that. I don't have the studies in front of me, but I'm sure that I've seen data that show that when there's a recession, the supply of new immigrants coming to Canada dries up quite quickly. So it's very much and also the other thing that happens is if you get unemployment soaring among the people that are already here, political pressure becomes enormous on the government to stop all those people coming in because they're taking jobs from people that are unemployed that could have used that job. So now that's not the situation right now. There's sort of a shortage of people to fill all the jobs, but in a recession that could change. If it did change quickly, then of course they would start putting up some roadblocks to immigrants coming in.
With work from home now being a thing, along with people buying products online and instead of in retail stores, could commercial real estate in Canada be in trouble long term?
For sure, I think there's a lot of signs. It's not a speculation any longer to say that we're going to see some really severe question marks hanging over some of the valuations of some of these, especially these office towers are the worst category, I think.
Yeah.
But shopping malls and shopping centers are also in real trouble. And Brookfield is a Canadian company, but it's a worldwide force in office towers and shopping centers. And they've already defaulted in Los Angeles on a couple of big towers. They just stopped making the payments on the loans. Now, they had arranged a financing so that there was no recourse. It's called a non-recourse loan. The only recourse the lender has is to seize the towers. So Brookfield stopped making the payments on two of these, like two of the biggest towers in downtown Los Angeles, and so Brookfield gets to walk away. I mean, they leave behind whatever down payment they put at, whatever equity they had, and the lenders now is the new proud owner of two new office towers. But I don't know what they're going to do with the office towers because the vacancy rates, which say in Edmonton and Calgary are listed as 30% or something like that, they're vastly understated because they've got 30% of the space spoken for under long-term leases, but it's not being used. It's not being fully utilized. So the vacancy rates are probably 40% or maybe even 50% if you counted all the space that was somebody was paying for, but they wish they didn't have a 10-year lease, but they can't get out of the 10-year lease, so they're stuck with it. So and of course things are, if somebody can figure out something to do with shopping centers and office towers as an alternative use, they can make a lot of money. But there's a lot of people who've been working on that for a number of years now, and it's not clear what the other alternative uses are. It's converting an office tower to residential, just for example, which is one thing that gets talked about a lot, is not that easy. It's very, very expensive because the construction methods are completely different. The plumbing and the heating and everything is done differently with a residential tower versus an office tower. So some people say, I think this makes sense to me, actually. Some people said it would be just cheaper just to start over, just do one of those things like they do in China, where they just implode the building and build a new building with a different purpose. But the other thing that's coming too, if it comes, I mean, we've been waiting for this for a long time. Elon Musk has been talking about this for way too long, is robotic car services. And if that comes, where you can just summon a car without a driver, you just get in the car and it takes you to your destination, you pay a few dollars, and then you don't have these parking lots in downtown cities, in the downtown part of cities that are sort of storing cars above ground for many, many hours a day. You wouldn't need that. So that's going to change things even more, perhaps, than the office tower situation. So that's another thing to keep an eye on. The cars would be much more heavily utilized, and you would see the cars just sitting idle for 8 or 10 hours a day the way they are now.
What are real estate developers doing right now?
Well, the house builders are still pretty optimistic, I think, because there's still demand, but there are signs of weakness. And the problem with house building is that it changes so quickly. So that the way it works is the house builder, whether he builds 10 houses a year or 100 houses a year, he has to go and put down a deposit on the lots, and then he tries to find some buyers for the houses. He's got a show home and all that, and he has to finance that down payment on lots. And then the real estate developer, who usually doesn't build houses, just provides the lots. He's put up a whole bunch of money to make the roads and the sewers and all that, and so there's a lot of money that's being put in at those two levels, the builder level and the developer level. Sometimes 2 or 3 years ahead of when the actual buyer takes possession of that house. So they have to predict ahead of time, and they tend to be optimistic people, or they wouldn't be in the house building business. But on the other hand, the lenders are really leery about house builders because they have a habit, an unfortunate history of going bankrupt when the downturn comes, and nobody can see it coming. So what happens is they end up borrowing money from the alternative lenders, and generally the interest rates start at 10% and they go up from there. So they've got these houses, they build them. The unfortunate thing is you build 100 houses, and it can be very profitable, but if you only sell 89 houses, you lose money. It's the last 11 houses out of the 100 or some number like that where all the profit is, and so if they're paying 10 or 12 or 15% interest on the cost of those unsold homes, they can go bankrupt pretty quickly. Especially now with homes being in the $500,000-$700,000 range. 10 homes is $5 million. So you're paying 10% interest a year. That's $500,000 a year. If the slump lasts 2 years, $1 million of interest, never mind all the other expenses the builder has, and they can be in trouble pretty quickly. So the big guys probably be okay, but there's an awful lot of builders that are in the 10 to 100 properties a year category, and those are the ones that would be in trouble for sure.
Where does the Canadian dollar play into all this?
Well, the Canadian dollar surprised me. It was 82 cents or something at the peak, and the recent peak. I mean, it's been over 100 cents on the American dollar if you go back far enough. But the recent peak, I think it's around 82, 83 cents. It's around 75 now. It got down very briefly down towards 70 cents in the last couple of years. But 75 cents is a pretty decent number for a Canadian dollar. It's being held up because of the oil market did pretty well there for a while. The oil price was up, I think, close to $100 a barrel for a while, and people still see Canada as a safe haven place to put their money. But I would be worried about the Canadian dollar because we got the oil market seems to have turned negative, and I think longer term it's a real negative because of the conversion to electric vehicles. About half of all of crude oil burned in North America goes into running cars and like trucks. So long term, that business is shaky, and then you've got we don't have with the conversion to electric cars. They're talking about giving Toyota $10 billion to get them to build a battery plant in Ontario. Well, we're not going to have the manufacturing facilities. So we've been losing manufacturing on the auto cars and parts for quite a while, and that is just accelerating under the electric. Unless we get lucky and land a couple of big plants here, but so we're going to struggle. On the positive side, though, which might be holding up the Canadian dollar or giving support to the Canadian dollar, is a lot of the minerals that are needed for the electrification, whether it be cars, or just a general move away from fossil fuels to electricity. A lot of the minerals that are needed, nickel and copper especially, are found in Canada. So that's the positive news. But unfortunately, there's a negative side of that as well, and that is that Canadian governments are very slow to get approval. So the length of time on approvals is like 15 years from planning to actual, when the first product comes out of the mine. And other countries like Indonesia, which has a tremendous amount of nickel, or even Australia, are able to move much more quickly. So Canada has the resources. Canada has a chance. But Canada needs to move quickly, and as recent history has shown, because we got the two levels of government, federal and provincial, we seem to find it hard to make decisions that require permits and that sort of thing, which almost everything does now. We seem to find it very difficult to move quickly, and this is a fast moving industry. The growth in China is just absolutely spectacular and mind-boggling. And people don't. I'm always amazed. I do a lot of research on this. I'm amazed at the numbers, and I honestly don't think people are aware of how dominant China is becoming in this segment. So they are way far ahead of us, and we would have to move very quickly. But we do have that one advantage, is that we actually own the raw materials that are going to be needed. And generally it's the batteries that need the materials. The rest of the car, not such a big deal, but not much different from now. But the batteries, of course, are the big new thing. And the main metals in the batteries are lithium and nickel. Yeah. But they need a lot of copper in. About 3 times as much copper in an electric car versus a regular car, mostly because of the electric motors.
Some businesses are starting to go cashless in Canada. For example, you go to BC Place to watch a football game. They don't accept cash. It's only cards. Do businesses in Canada no longer need to accept legal tender? Is it legal for them to say no to cash?
I don't know. That's going to become a political issue, because I know that it's probably it takes all the fun out of having a small business, right? If you can't accept cash, you have to pay tax on all your transactions. Then I lived in France for a year, and it was in the 70s, and they were just going through a conversion. And all the cafes and restaurants were really upset because they didn't want to report all their transactions to the government. So I don't know. I think it'll be a fight for sure. But having said that, when you go to a hockey game, the busker's there playing his guitar and singing songs. He's got a little thing where you can tap your credit card in there to give him some money. He's got the guitar case open with some $5 bills in it, but he's also got the little thing there where you can tap and pay him through a debit card or credit card, or your phone. So it's coming, I guess. I don't know. It's not that. I mean, people read all kinds of conspiratorial things into it, and maybe there is a plan to control all of us through our credit cards, and our only way of being independent would be to have gold bars, and gold bars, a bunch of guns, and a year or two supply of canned goods, and a cave somewhere in the mountains where nobody knows where it is. But if things get that bad, though. You're going to have some kind of protection, because there'll be there'll be people that coming around that have that are stronger and bigger and faster and have better guns than you do. So how are you going to protect your stash from?
It'll be like New Orleans after Katrina.
Yeah,
where they were just Mad Maxing it for about a month. Are there any stock market sectors you're bullish on right now?
Well, I'd like to start with the ones we avoid. We definitely avoid. So there's about 7 companies in the U.S. S&P 500. So 500 has 500 companies, right? And 493 of them are regular, but there's 7 of them: Microsoft, Meta, and Amazon, and Alphabet, and Tesla, and now NVIDIA, and I think that's 6. But anyway, they're just so expensive right now. They've gotten to the point where they're represent about those 7 companies represent about 30% of the value of the S&P 500. And that's even more significant than it sounds, because the U.S. market is about 60% of the value of all the stock markets in the world. So those 7 companies being 30%, it's about they're close to 15 or 20% of the value of all the stocks in the world. And that's only happened in times like 1929, and that when the wealth has been concentrated just in half a dozen or a dozen companies like that. There was an era like that in the 60s and 70s called the Nifty 50, and then we had something similar in the dot-com bubble in 2000, and all of those ended badly. So that's the first thing, is to avoid those overpriced stock. And the thing is, people don't realize is that when you buy an ETF of the stock market, you end up putting most of your money in those 7 companies, if it's because they're balanced, they're weighted by market capitalization. On the other hand, on the opportunity side, as you know, I've been keen on the alternative energy, renewable energy, electric vehicles, electrification. That is moving ahead so quickly that would be the area to concentrate on, and that's where we plan to concentrate a lot of our investing on for the next few years, if things continue the way they are. So now, if we get, I talked a minute ago about the bear market lasting 3 years, and we're a year and a half into it. The second half of the 3 years is the most challenging part of a bear market. So the opportunities for renewable energy will get better in the next 6 months, 9 months, a year, if the bear market continues for another year and a half. But that would be the area that I would, the amount of investment that's required to go into to convert our systems away from fossil fuels is just enormous. We're talking $3, $4, $5, $6 trillion a year, which is about 5% of the global GDP. So it's very doable. But there's not that many investments that are trading on the stock market in relation to the size of that investment. So there's going to be a lot of money pouring into institutional money, pension plan money, all these different institutional investors will want to get a piece of that action. And so there will be lots of new companies that start up. There'll be a lot of speculative companies that start up. There'll be a lot of scams that come up as well. So you have to be careful which ones you get. But the companies that are real companies that are doing real things, that'll be a very rewarding place to do, I think. And it might take 10 years, but 10 years goes by pretty fast in the stock market. People have been used to. It's been 23 years since the dot-com bubble burst in 2000, and there's tremendous opportunities with that. They were better 2 years later in 2002 than they were in 2000, but it's just going to be a similar kind of thing, like a 20, 25, 30-year run in the renewable energy sector.
Now, I think you touched on this, but Tesla versus the legacy automakers in making electrical vehicle production profitable, what is the difference there?
Well, the problem is that like Ford, for example, they just announced today that Ford's going to get $11 billion, billion with a B, loan from the government department that makes these loans, and Ford is also going to lose $3 billion in profit. They're going to have a loss of $3 billion just in their electric car division alone. They, of course, they make a profit in the regular business, like selling Ford F-150s, not the Lightning, which is the electric one, but just the regular ones. So they need help. They need that $11 billion will last them 3 years at that rate of losses of $3 billion a year. But they have to make such a massive investment in converting their systems over to manufacturing electric cars, because it's quite different. I mean, the wheels and the chassis are somewhat similar, but the battery is way different from an internal combustion engine. And then the amount of at least with Tesla, the amount of computerization in the car is night and day different from a regular car. So all of that is ahead of those guys, and that's going to be a big challenge. So Canada's announced a $10 billion loan to Volkswagen to put a battery plant in Ontario, I think, and there's another company that had agreed to a lower number, and now they're renegotiating for a higher number because Volkswagen got $10 billion, so they think they should get $10 billion. So there's a lot going on. Now, just some of your listeners will know that there's been a lot of complaints about Tesla getting government support going back. Now, this goes back, I don't know how many years, I think it's probably 10 years when they first started making the Model S. The loan that they got was $464 million, and they repaid it with, I think by 5 years after that, they had repaid the loan in full. So there you have it, $11 billion versus $464 million. So it's about, the Tesla loan was less than 5% of what Ford just got announced. And Tesla in 2023 is probably going to produce 2 million cars, and by 2026 they're hoping to produce 5 million cars. So we'll see if the legacy automakers can get up to that kind of production with those loans. I hope they do, because we need this conversion to happen quickly. But it's going to be a challenge. What they really should do is just copy exactly what Tesla's doing, just put a Ford decal on it and carry on. But I don't think they're going to do that.
Hilliard, thank you so much for being on This Week in Money.
It's great to be on, Jim.
My guest has been Hilliard Macbeth, author of the second edition of the book, When the Bubble Burst, Surviving the Canadian Real Estate Crash. His website, MacBeth.Partners.com. You can find him on Twitter at HMacBE. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, John Rubino, and Hilliard Macbeth. And thank you for listening. If you have any questions for the show or our guests, you can send them to info@housestreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of House Street Media Incorporated. Executive producer is Tom Allen.